This has never happened before, and it's going to trigger a massive recession. I'm your host, Steven Van Metre, and thanks for joining me today. And in today's show, I want to take you through the problem and the reaction, because when you see what's about to happen, which has never happened before, well, you're going to draw the same conclusion I have, and that we're headed toward a massive recession. Let's start this out with a trip over to Bloomberg, who headlines that U.S. inflation charges higher with larger than forecast gain as the price index posts the largest 12-month increase since 1982. And it's got traders panicked as expectations for a half-point Fed hike coming in March. The consumer price index climbed 7.5% from a year earlier, following a 7% annual gain in December, according to the Labor Department data released today. The widely followed inflation gauge rose 0.6 in January, which is super hot, from a month earlier, reflecting broad increases that include higher food, electricity, and housing costs, which all of us probably know. Excluding the volatile food and energy components, so-called core prices have increased 6% from a year ago, also the most since 1982, and 0.6% from a month earlier. And here you can see in the report, it was indeed broad-based. We see all items up 0.6%, but look at this. Only two things that didn't matter were medical care commodities and medical care services were the lowest too. Beyond that, we see services inflation up over 4%, and that's on the low end. We come up here, food up 7%, and energy off the charts. Of course, if you filled your gas tank up lately or turned on your heater, you already know this. So this was a broad-based report, and you can start to see where the problem is, because this data reinforces the Fed's intentions to begin raising rates next month to combat broad-based inflationary pressures that could lead markets to expect even more aggressive action from the central bank. And the steady run in prices has eroded recent wage gains and diminished American families' purchasing power, sucking much of the era of what has been an exceptional bounce back in the U.S. economy. And that is starting to be the problem here, is that without fiscal stimulus and withdrawal of monetary stimulus under a regime of high inflation, well, the outcome's not too good. But let's keep digging into this problem, because even so, wages aren't keeping up with inflation, as inflation-adjusted average hourly earnings fell 1.7% in January from a year earlier, marking the 10th straight decline, separate data showed today. And for President Joe Biden, as I've mentioned, this being a political issue, the decades-high inflation presents a risk to his party's razor-thin congressional margins ahead of the midterm elections later this year, with many pointing to the White House's stimulus bill last year as a key driver of the price increases. Biden's approval ratings have taken a hit as Americans face higher prices at the gas pump and the grocery store. The report will likely further diminish the chances Biden's Build Back Better plan will pass, as Senator Joe Manchin of West Virginia, who has repeatedly stalled the legislation, has frequently cited inflation as a reason to slim down the package. And that is another problem, because consumers right now don't want more inflation and is seemingly running out of control. But there's also even further problems in this report, as the latest CPI figures also reflect an update to the relative importance of certain categories in the consumer basket, as we covered in yesterday's show. The new weights, which are based on spending habits in 2019 and 2020, include changes like a bigger weighting for used cars and trucks, a reflection of how the pandemic changed the consumption patterns in the U.S. And this is a goods-dominated inflation backdrop. If the transition from goods to services spending is slower to evolve this year, you can continue to see some additional upward pressure on inflation. Of course, we know there's lots of goods sitting outside ports of California at Long Beach and Los Angeles, and there's goods trying to get across the Canadian border right now, but that is still a problem. It's going to potentially keep inflation high, especially with those weighting adjustments. So now that we understand the problem, well, now we need to look at the reaction, and then we'll take a look at how this will turn into a big, giant mess. And Fed's board back supersized rate hike sees full point by July 1st. This came out today. He said, "I'd like to see 100 basis point or 1% in the bag by July 1. A voter on monetary policy this year said in an interview with Bloomberg this morning, "I was already more hawkish, but I pull up dramatically what I think the committee should do." And here you can see there's only 3 meetings before July 1st. There's March, May, and June, meaning that one of those meetings would need to be a 0.5% rate hike, because the Fed normally only does 0.25% when they increase. Now, if you're concerned about how this mess could lead into a recession and really tank your portfolio, well, take a look at Portfolio Shield. There's a link up in the corner there and in the description below. You'll be glad you did. Now let's get into how this has never happened before and what it means for the broad economy and an upcoming recession. So let's start out here with U.S. real earnings month over month came in at minus 0.5%. So real meaning inflation adjusted earnings. Now, of course, if you're working, you already know that your paycheck is not keeping up with inflation. But look back, we see October minus 0.9. We see a minus 0.2 revised down to minus 0.4. We see last month what I was suspect of at a positive 0.1 revised down to minus 0.3. And now we have the fourth consecutive month of negative numbers here. And again, as we know, paychecks are not keeping up with inflation, and that leads to less consumer spending. At least in the short term, consumers could charge more, as we talked about in yesterday's show. But if they don't feel their pay is going up, well, they'll cut their spending. Let's keep going. As we can see, here is that U.S. real or inflation-adjusted average hourly earnings, 10 months in a row, negative again. And what is the issue we're facing? This never happened before. Well, we have never actually tightened or withdrawn monetary policy at a point where incomes are negative against inflation. And I want to show you this because this is really important. And when you understand how this is going to play out, well, then you'll know that we are headed toward a recession. Here you can see real, or again, inflation adjusted disposable personal income, which represents about 80% of the economy. And let's just go back into the 70s here. And I've got the federal funds rate in red. And you'll notice on the right is a percentage change of year over year on the real disposable income. And somewhere right here is between 0 to 5, we'll say around 3% tends to be around the norm. And so here you can see the real disposable income was running to somewhere between, say 2.5 or 2 and 5%. And the Fed engages in a tightening cycle. What happens? That real disposable personal income goes down, triggers a recession. And then we can see here's another example. The Fed's tightening, but incomes are high enough, and what that means is people are able to absorb the tighter financial conditions, but this slowly degrades until it hits a recession. Here you can see the dot-com bubble. While not as dramatic, but real disposable personal income fell just enough because people couldn't afford to make payments on all the mortgages they had. But again, a Fed tightening cycle happened when the real disposable personal income was running at a fairly strong number. Here we can see going into the great financial crisis, the Fed is tightening. Real disposable income is up here, is running, around 4%, and it dwindles, and then boom, goes down to zero, and then you've got your big financial crisis. And where are we at now? And this is important to understand. The Fed actually hasn't tightened. They're just withdrawing stimulus, and your real personal disposable income is at? Yeah, it's at zero. It's at zero. It's already at a point where we would normally have a recession, and what the Fed should be doing right now is easing, not tightening, and they're going to tighten into conditions that have always triggered a recession, and that is just baffling. And as we add on to other things that are interesting, we see today's bond auction adds to the narrative that I've been sharing with you that all that matters for long-term yields and the bond market is foreign demand, which picks up during inflation. And adding to that story, today we see the U.S. federal budget balance was positive, $119 billion, meaning we actually ran a surplus. And when we run surpluses, well, guess what that means? We need to borrow less in the future. In today's 30-year Treasury auction, while the yield was high at 2.34%, the demand from foreign investors wasn't the highest on record, but it was up there in the top at 68%. So there's a huge demand from foreign investors, leaving dealers with very little amounts. And here you can see I've taken the federal debt held by foreign and international investors in blue, inverted it, and overlaid the 30-year Treasury yields. And this is neat because what you see as foreign investors take more and more U.S. debt, which is, again, part of how our monetary system works. We export dollars through trade. They take the excess dollars and buy U.S. Treasury securities and hold them as interest-bearing assets. And if they need dollars, well, they simply can go out in the market and convert them back to dollars. But in the meantime, the reason they don't hold dollars is because they don't pay interest, and Treasury securities do. So their goal is to accumulate Treasury securities through trade. And so what you see here is when yields go up, even as foreign investors are taking more and more U.S. government debt, you can see yields come crashing down. Here you can see this was after President Trump got elected for his term, and you can see that yields spiked. But look what happened. Foreign debt held by foreign institutions was still increasing, again shown inverted. And what happened, despite all this inflationary hoopla that his administration was going to create, and it didn't work out. And what happened? Yields came down. And again, we see this now that, hey, all of this stuff we're doing, all of this fiscal stimulus and monetary stimulus and government transfers is going to lead to inflation. But what it's telling us is the exact opposite is going to happen, and that yields are going to come down. And what matters here is foreign demand for treasury securities, which goes up when the inflation is high. And even as inflation comes down, guess what? Their demand stays high, and they eventually squeeze out all those people who are short and betting on higher interest rates. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational and not intended to provide investor advice. This is not to be construed as recognition or solicitation by a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, opinions expressed in this video that do not affect the valid financial advising or Steven Van Metre Financial.